Hi, everyone. Thank you for joining us today. I'm Marche, the webinar director at Advice Chaser. Before we introduce our guest and get started, I do need to do a bit of legal housekeeping. Advice Chaser, the host of this webinar, is not a registered investment advisor. We cannot and do not give financial advice. Today's presentation is for educational purposes only and cannot be considered advice for any person's individual situation. Advice Chaser regularly hosts informative webinars, such as this one, featuring a variety of knowledgeable professionals, many of whom are licensed advisors. Any opinions, ideas, jokes, or principles expressed by presenters are their own, and however true, funny, or interesting, are not endorsed by Advice Chaser. Please do not act on the information you hear today without consulting a qualified financial professional. We're thrilled to bring you this educational presentation today. Attendees are muted, but we do encourage you to ask questions using the chat box. The presenter will answer those queries during or after the webinar today as appropriate. If you ask a question in the chat box, go ahead and leave your contact information as well. If we can't get to your question during the event, we'll make sure someone reaches out to you afterwards. We want this experience to be as educational as possible. So again, please don't hesitate to ask for clarification or expansion of the material. I'd love to introduce you to our presenter today. J.R. Gururi is a certified financial planning practitioner that utilizes a unique approach and methodology called financial life planning. Life planning connects the dots between our financial realities and the lives we long to live. This method is based on the premise that advisors should first discover a client's most essential goals in life before formulating a financial plan, so a client's finances fully support those goals. As a lifelong learner, musician, and athlete, JR holds a black belt in Brazilian Jiu-Jitsu, trains Muay Thai, and has been playing the guitar for over 30 years. He actively performs and writes music in his band. And JR, we're glad to have you back. And let's go ahead and launch right into this.
Okay, the most exciting subject we've done so far is tax planning for the future. So I'll do my best to keep this enjoyable experience. And, you know, just the overall idea that we had in putting together this presentation is to give what I would say is just an opinion, right? This is my opinion on thinking about taxes. I am not a CPA, right? So this is not a conversation where we're going to go real technical, nor am I an attorney who like a tax attorney. So some of the things that I may say today, they may disagree with, and they may be correct, and I may be wrong, or I might be correct, and they may be wrong. It's more of an opinion, a general discussion, some of the basics about thinking about tax in the future. The problem is typically when we think about taxes, we think about tax in the way we deal with it annually, right? Every year I do my taxes with some sort of professional, and that's April 15th. And then we either pay or we get money back or get nothing. And that's typically how tax is thought of. And what this presentation today is, no, we're not thinking about today's taxes. We're planning for the exposure to future taxes in, let's say, a moment of time called, let's say, retirement, right? That kind of thinking. So that's what the premise of this presentation is. In order to start that conversation, we need to get some basics on taxes. So we use the term called income tax to determine how much tax we're going to pay in any one year annually by the end of December, 31st of that year. And then we make that we paid that bill on April 15th after some professional helps us do that. So depending upon how much money I made from January 1st to December 31st, my income, that would put me into a bracket. And we've heard about which tax bracket are you in? Are you in a low bracket? Are you in a high bracket? Those brackets and the amount of money that's you pay changes all the time, changes from year to year. Sometimes it's longer, sometimes they stay in place for a while, sometimes they don't. So that's what income tax is all about. Now, we hear about these things, oh, do I get a deduction on my taxes? So a deduction means if I make $100,000 in a year and I was able to deduct something, my income gets from 100,000, let's say if it was a $10,000 deduction, down to $90,000, and then I'd be taxed in a $90,000 bracket. That's what a tax deduction is. The other thing that's probably really interesting to understand, which is more powerful, is a tax credit. So if I owe the government at the end of the year, let's say, $2,000, and I get a tax credit for $1,000, that actually means the actual amount of money I pay to the government is reduced by $1,000. So that's the distinction there. It's just people hear these words a lot, they don't know what it means, right? Deductions are against the income and credits are actually a credit against the actual bill I have to pay. The next thing we discuss on taxes is capital gains, typically. So capital gains is we will pay taxes on profit we make when we sell something that we previously owned. Like we can sell stocks, or we can sell real estate, all right? So we could sell a business. So we sell these things and then we have a profit, therefore we owe money. Well, if it's long-term, okay, so long-term means that typically if I own it for more than, let's say, 1 year and 1 day, well, the tax amount would be probably, well, in today's numbers, 15%. For wealthy people, it'll be 20%. Well, that's a big difference. 15, 20 is different from if I had to pay maybe in a 40 or 50% tax bracket for my income. So typically the income brackets are higher than the capital gains. But if it's short term, meaning I buy and sell something within like a few days or a few weeks of itself, well, guess what? Now you're back into that 30, 40% in the income tax bracket range. So that's how that works. So holding things for longer periods of time is more efficient from a tax perspective. But you can also use something called losses. And losses is when I lose money on the sale of something, I can make that go, that like loss, take it against some sort of profit I have somewhere else. And you can play this game all day long. Again, this is what CPAs and tax attorneys are for, is to help us run through that math strategically. But I just want to give you a basic sense. And then also we receive something called dividends and interest. So dividends are taxed similarly like capital gains, meaning if I generate a dividend and it's long-term, then I'm going to pay this like 15 to 20% potential tax. And interest, however, is not taxed favorably. That puts you back to the income level. So if I pay 40% in income tax, I'm paying 40% on interest. And we usually get our interest from where? From bonds. We get them from money market accounts, or banks pay us interest on our bank accounts. That's where interest taxes, that's where taxes from interest come from. Okay, that's the basics. That's all I'm going to do for that. If you guys want to ask me more questions, you can try me out later on about the basics. Okay, from there. Okay, so like I said before, we're looking into the future, right? Long-term financial planning. And when you put yourself, when you start putting money in savings today, so when I say the word savings, I mean, I can put it into my 401k at work, I can put it in my bank account, I can put it into the stock market. I have a choice of where I stash these dollars. And every place that I put that money has its own unique tax burden, right? So we need to understand all the different asset classes have different tax rates. And that's what we're going to discuss today. All right. And then again, another thing that we have to understand is if I pass away later on in life, which is probably going to happen to most of us, right? So what happens to the dollars left over? Do my family get those dollar friends or charities? Do they get that money tax-free? Do they not? Do they still owe taxes? We're going to talk about some of those things. Next slide. All right. So when I said before, when I go and save dollars, there's different categories I can push my money into to save for my future. So we listed some basic ones here. I can put my money into a traditional retirement account. We call those traditional 401ks or traditional IRAs. Essentially, I am not paying tax today on those dollars. Those monies will grow into the future without paying taxes. But then when I'm in that place called retirement, and I start pulling the money out of the account, then I owe the taxes. Roth is the opposite. I'm going to pay the tax today. The money will grow without taxes into the future. But when I pull the money out of the account in retirement, now I have zero tax responsibility. So a different strategy. Social Security. So most of us are paying into Social Security every year based on our paychecks and our income. And then when we get into retirement, we start receiving these dollars, and then there is a tax burden on those dollars, most likely for anyone on this conversation, but there's a chance that you might not have to. So we'll talk about that in a second. Real estate. So we discuss either my house counts as a tool, or investment properties can be a strategic tax tool. Life insurance is a tax tool for if I'm to pass away, what happens to those dollars. But life insurance also goes into a category of it's an asset class where I can have dollars to use while I'm alive, not only when I pass away. Brokerage accounts are typically our stock accounts, bond account, maybe gold and silver can be done inside of a brokerage account. Business ownership is I own my own business. And then finally, other alternative asset classes all have their own tax categories, like art would be an alternative. Okay, traditional retirement accounts. So here's what happens with this. I put my money in a 401k or a traditional IRA every year. And I actually get what we call a deduction. Remember the word deduction. So if I make 100 grand, I put 10,000 into my 401k, that's a deduction against my income. So now I'm making $90,000 for the year in the eyes of the government. Okay. But those $10,000 escaped taxation, went into a specific account called the 401k or IRA, grows without taxes. And then in retirement, I take the money out to spend because I got to eat and I got to live and I got to travel. So I pull the money out of the account. I'm going to be taxed, and I'll be taxed. I'll be forced into the income tax bracket based on how much money I pulled out of the account that year. Okay, so now when you're in this place called retirement at the age of 72, the government requires you to take money out. You have a choice, but you really don't have a choice, right? You have to pull the money out because otherwise, if you don't, you get penalized. And penalized is it's like 50% of the amount of money you should take out. Like, it makes no sense not to do it, right? So I have this retirement account and I pull the money out, I get taxed on it, and you have to do it by age 72. Every year moving forward, there's a complicated math calculation to figure out how much you have to take out every year, but you do have to take the money out of the account. Now, what you do with the dollars after you get them, you're allowed to put them back into the market if you want to, or you could stick it into your bank account and spend it on the things you need to spend it on. But you have to take the money out because the government wants their money. They want their taxes. They haven't been taxed yet, so they want that money. Okay. Roth accounts are like almost complete opposite. I'm paying taxes today while I'm working. Money grows without tax. And when I pull that money out in retirement, I don't have to pay any taxes on those dollars I receive. So that's a very good strategy. So having both of these accounts in retirement can be advantageous. Like having one, you have no strategy. Having two says, I have a choice now. I can use this account. I can use this account that year. That's really helpful. We also hear about this word called Roth conversions. What's a Roth conversion? So a Roth conversion says that I can take dollars that haven't been taxed yet. So where are the dollars that haven't been taxed yet? The answer is in my traditional retirement account, my 401k or an IRA. Money hasn't been taxed there. What I can do is every year I can move money from a traditional IRA into a Roth IRA. So I just move money from one account to the other and then pay taxes on the amount of money that I moved. So if I moved $10,000 that year, I'm going to pay income tax on the $10,000 that I moved over from one account to the other, pay the taxes today, and then what happens? Those dollars don't get taxed in the future in retirement. That's a conversion, right? And so having that ability to do that puts you in a situation, having a strategy in place for those future dollars. Remember, the longer they sit there and grow, the more money they tend to become over time. And if they're escaping taxation, that's a powerful position to be in. So the strategy with a conversion is you try to do it in a year where the tax burden in that year is low, right? See, if I'm having the best year of my life financially, you don't want to do a Roth conversion because you're in the highest tax bracket that year. But if I make less money this year relative to other years in the past, Now the conversation for a conversion becomes really interesting. That's the basic premise. It gets way more complicated, not for this presentation on Roth conversions, right? So, but that's the general concept. All right, next slide. Oh, go back to that slide one more time. Sorry. Okay, when you pass away and you have a 401k traditional IRA, that money does not go to your heirs tax-free. Does not. Typically, what there'll be is some sort of spend down feature, meaning that you should spend the money down. You can take it all at once and pay the taxes, which would be a very big tax bill. You take it out of the account, all right? Or you could spend it down over a course of, let's say, 10 years. You'll have to pay taxes, per year. And there's a lot of different strategies around that. But the money does not go tax-free to your heirs. So that's something that's kind of important. All right, next slide. Okay, Social Security. If you make, so in retirement, you are going to be generating an income. Social Security counts towards that income. All right, so if you make less than $25,000 in retirement, so you didn't make a lot of money in retirement. Well, if you make less than $25,000 and you're an individual, then you will not pay taxes on Social Security dollars. That's a very low amount of money to make. Theoretically, people on a wealth building presentations trying to learn how to make a lot of money by the time they retire. But so therefore, if you make more than $25,000 a year, you will pay taxes on those dollars. Now, they give us some kind of break on it in that if you make between $25,000 and $34,000, half of the dollars that you make from Social Security go into that pool of income tax. That's what that means, right? But if I have, if I make more than that, then 85% of the dollars that I've received from Social Security that year will be in your income tax bracket. That's a lot. That's a mouthful of jargon. There's no other way to say it. That's easy. I mean, I'd have to talk to everybody individually and write down on a piece of paper what that looks like. But the answer, for generally speaking, most of you will pay taxes on your Social Security dollars that you make, period. So, and that's just the way it is now. Remember, that's a good point. Everything I say today is completely subject to change in the future after we get new laws and they change the rules on us all over again. So all this stuff will be different in the future. You just have to swallow that. So that's how you do it. Okay, next one. All right, real estate. A lot of people don't know about real estate as a strategic tax planning tool. So let's just look at it from two perspectives. One perspective is the house that I live in, and that's all I have, and that's great. Or I have investment properties. So investment properties are so the concept of an investment property is I already own a home, but I decided to buy another piece of real estate, right? So I could either rent it out and do like Airbnbs, if you will, or I could buy it, fix it up, and then sell it for a higher price in the future, right? So when I do the concept of buy it to rent it out, you now have a asset that if you're making positive rental incomes, okay, then you now have an income source. And it's a tax advantage income source in that the home itself that you're working with, you can deduct the expenses because there's going to be expenses inside of that piece of real estate. And I promise you, renters are costly, right? They cause damage to your washing machine or whatever. So you can start writing off the expenses against the income generated by the property. And so now you have this sort of tax mechanism going on there. And then if you buy and sell properties, right, the amount of work you put into fixing up the property is another thing that you can do to reduce taxes inside that unique property itself, right? And so we could talk about good years and bad years when you want to buy and sell properties. And so you could start playing the game of strategy with around tax with investment properties. The other thing people don't understand is that the home that they live in, even if they decide to live there for the rest of their lives, is a tool that they can use to reduce taxes in a year. Because if I pull money out of a piece of real estate that I'm already living in, the way in which you do that is through like a cash out refinance, home equity line of credit, which you see that HELOC, we call them, or a reverse mortgage. Those are the three ways in which you can remove money out of a house that you're already living in. Now, the reason why you can remove money out of it is because an institution like a bank is lending you the money. So that you're being lent money, it's getting into your checking account, and you get to spend it as you see fit. Well, when you get lent money, you don't pay taxes on those dollars. So now you have a strategy like, wait, oh, I can take money out of my real estate in a year that it might be very advantageous for me to take money out from the real estate and not some other account, right? Like maybe a bad stock market year. Listen to that strategy for another conversation, and have no tax burden, right? Because I didn't sell something for a profit, or I didn't make an income. So therefore, we now have a tax strategy that we can use. Now, with a reverse mortgage or a home equity line of credit or a cash out refinances, they also have their own pros and cons and fees and costs associated with them. So they have to be handled in a, a delicate fashion, if you will. All right, so that's real estate. Life insurance. Okay, so life insurance comes in sort of like two mindsets, right? It's one mindset is what happens when I pass away? Well, when you pass away, for most life insurance policies, typically, the money received by the heir is received to them tax-free. That's generally how it works. Now, there's nuance to this, right? So you could like get on a phone with a lawyer and be like, wait. He said it was tax-free and you're saying it's not. Yeah, you have to like get into the weeds on this. But generally speaking, people receive money tax-free. Okay, so that's a powerful situation to be in if one of the goals that you have in your financial plan is to take care of others when you disappear, right? Or take care of charities, take care of being philanthropic. So if that's a goal of your retirement is to help others, well, life insurance becomes a good conversational piece, right? So, but then we move on to the other side of life insurance, where life insurance as an asset class, meaning that it's a tool that you have, a financial tool that you have that has like, I don't know, let's just call it simple. There's money inside of it, right? And so permanent life insurance products, not term, permanent life insurance products have a cash element, or what they call the cash value. And you can remove the cash value out of a life insurance policy and spend it on all the things you want to eat and go take vacations or whatever you want. You're allowed to take the money out of an insurance policy. So in some circumstances, if you take the money out of an insurance policy where you essentially borrow the money out of the insurance policy, you now have an opportunity to receive dollars tax-free, because it's not the selling of a product, but it's the getting money from being lent money from an institution and paying interest and all those other things that will come along with getting a loan. But it is a tax-free tool. And again, same thing as with the real estate. Sometimes, depending upon the circumstances of the year in which you're doing your taxes, if you need to be in a lower tax bracket, one way to receive money that you still need to survive is pull it out of the insurance or the real estate rather than the 401k while in retirement. So that's the kind of thinking that it's like, oh, I get to choose from the different things while I'm in that year making decisions around my taxes. Okay, next slide. All right, so brokerage accounts. We use the term brokerage accounts very loosely in our society, and it has a lot of meanings. Generally speaking, what you're talking about is what we call a taxable investment account, meaning that the account, when we say taxable, it's like what we call a non-retirement account. It's not associated with retirement. I can put money into it and take money out of it without having to deal with any kind of penalties, because we know that with retirement accounts, if I take money out early, there's a potential for a penalty. So a brokerage account or a taxable account or a joint taxable account, they're all kind of the same language for the same thing, is where we do a lot of like buying and selling of typically stocks and bonds, and you can do gold and silver inside of these things, and REITs and all kinds of interesting assets. So they get taxed differently. So typically in brokerage accounts, we deal with capital gains. So capital gains means I pay money only on the gain. So if I buy something for $100,000 and sell it for $150,000, I have a $50,000 gain, right? So I only pay taxes on the gain, not the $100,000 I put in. So that's the distinction. Now, what rate do I pay at? Well, if it's long-term, for most people, they're going to pay either 15% or 20%, depending on their income tax bracket. And that's much less than 30, 40, 50%, depending upon where you are in the country, right? So long-term gains are, they're better than, it could be higher is what I'm saying. So long-term gains are good. Now, short-term gains means if I tend to own something for a short period of time. Now, different assets have their own time frames, but generally speaking, long-term means 1 year and 1 day, and short-term means less than 1 year. And so if I own something for less than 1 year, so I buy something today, sell it next week, now I'm dealing with higher tax burden, right? Now you're back into that 30, 40, 50% like you would deal with in your income tax bracket. Now, dividends are something we receive from the institutions that we own via our stocks. And if we get this income, it's like essentially what it is income. If it's a qualified dividend, meaning you own it for a certain period of time, and there's a lot of nuance to how much time that is, but generally speaking, they're taxed favorably at like a 15 or 20% rate. But if they're non-qualified, means you own them in a short-term situation, or then you're back to this 30, 40% tax income level. Interest inside brokerage accounts are not taxed favorably. They are at your income level at 30, 40%. That's a lot of jargon right there. Again, I'm sorry, that's as best as I can do to simplify it in a short period of time. Okay, owning a business is one of the most strategic tools that we can do for taxes as we're in the business year after year. And the reason is that we get that concept called business deductions, right? And so we have business expenses goes against the profitability of the company, which reduces tax burdens as time goes on, right? So there's that potential for a unique tax planning tool. And that's where, a good CPA and bookkeeper comes in. But we can use our business when we're in retirement as a mechanism to deal with taxes. So the problem with a business is that like a lot of people start their business from ground zero, and they put like a few dollars on the table, they start their business, and all of a sudden they're this success over 20, 30 years doing the same thing. Well, guess what? You haven't paid any taxes on the growth of that business. So if you were to just like sell the business the day you retire, you have to pay taxes on the gain of what the value is of that company over that time frame. That could be a huge tax burden. So you have to be careful with how you get rid of your business. Do you sell it all in one fell swoop? Do we use exit planning? That's the word on there. So exit planning or succession planning is a field in financial planning where you bring in strategic professionals like lawyers and CPAs that understand how to exit a company, pass on the ownership to someone either you want it to be, or sell it to anybody that or it could just be, a stranger. You can sell it to a stranger, but not pay all the tax burden in one transaction. You could spread it out over time. There's a lot of nuance into that. Too much information for this meeting, but that's the general idea. But yeah, there has to be some planning around it. Okay. So the other thing that we have to discuss is, all right, JR, here I am in retirement. I have all these accounts. What is the best strategy to reduce to spend my money down over time over the next 20, 30 years? Well, the answer to that is a concept called asset location. And so I do encourage everyone to do their own homework on what asset location is. I'm going to give you a general strategy that PhDs who do work on this tend to like and say often, is they say, what you would want to do is pull money from your brokerage accounts first, spend them all the way down to zero. When they hit zero, then you move into your 401ks and traditional IRAs. When those get all that down to zero, then you could use your Roth and spend that down to zero. And that's the way you would do it over time. It doesn't work that perfectly in real life, right? Because there's nuance, right? And so what you can do is like you look at it year by year. So if I'm like within a few dollars of reaching a new tax bracket, depending upon how much money I've made in that year for whatever it is that I did, if I don't want to break through that tax bracket, because by taking more money out of, let's say, my traditional IRA, what I can do is but I still need the money to survive. Well, take it from like the Roth account that year. Now I got the money, I'm able to eat, but I didn't push myself up into a higher tax bracket that year. that's sort of the concept of asset location and doing it correctly. The other thing that I really like about making good strategic decisions around retirement planning is the concept of spending down money. And so this tends to lend itself to more of the brokerage world. But what happens is, see, if I have money and I keep spending it down as much as I possibly can mathematically, let's say from like age 70 to 100, I can say, all right, well, how much money, how much can I take out of this thing between that year and this year and spend it down to zero by, let's say, 30 years from that? What's happening? Well, every year you knock down that account, the account gets smaller and smaller. Well, guess what is smaller and smaller? The taxes associated with it. Moving on. So in the beginning, you're paying more, but as you get further down the road, you're paying less and less along the way. That's an interesting concept. I would have to sort of map that out for someone visually to see, know what I'm talking about. But spending down money is a great strategy to reduce the amount of taxes you pay in the future. That's an interesting concept. And that's it. So do we have super complicated, wild questions that I have to answer? I'm not going to know the answer to.
I don't know if we have too complicated, and definitely if there's something in here that you would rather say we need to have them talk to their accountant or tax lawyer, then we'll definitely address that. Okay, here's a good question. Does it make sense to start a hobby business in retirement if I'm not planning on really making money, but using it for the deductions?
Well, yeah, having a business in retirement is a great place to utilize for deductions. That's very good. That's a great question. And the answer is yeah, that it could be a tool that you can utilize. It could be, not guaranteed, but could be, yes.
Okay, here's another question. With the standard deduction being so high, is there a way that that I can, is there a strategy to itemizing when, again, the standard deduction is so high, most people don't itemize anymore?
Well, high is a relative thing, right? You say it's high and I say, well, it should be higher, right? So I don't know what do you mean by high, but I would want a bigger, higher deduction, but it just, the concept is, so to itemize, when you itemize something, you want the itemization to be higher than what the deduction is, right? So if you end up in a situation where the itemization is higher than the standard deduction, go that route. I mean, that makes a lot of sense, but you don't do that if it, typically you start, like when you start looking at things like that, you've added complications to your existing financial life. Are the complications worth it, right? Are you generating more money with these complications? Then yeah, go for it. Are you potentially setting up for, different asset classes to take on by making these situations? Yeah, go for it. But yeah, that's a tough question to answer. Like, yeah, a lot of people are not getting any more benefit by itemizing anymore. The deduction's so high for them, right? So.
All right, here's another question. Can you speak a little bit about annuities and the taxes from, I guess, the income you get from an annuity?
Yes. So annuities are super complicated when it comes to taxation, right? So you have annuities that have never been taxed, okay, and they end up in some sort of, let's say, traditional IRA. If they're just left there, you're going to pay taxes on it at a very high rate, right? Then you have annuities that have exclusion ratios in them. So part of the amount of money you received gets excluded, and then part of it gets included. And so now you're dealing more, that's more along the lines of, and that's complicated. You would have to look at, like, you'd have to have like this done by an insurance professional, or annuity professional in concert with your CPA to like look every year, well, how much am I going to pay in taxes on this particular annuity? Because some of it's going to be taxed and some portion of the amount of money you receive is not, right? Because part of it is your principal, right? So that's typically done in the world of taxable annuities. And then you could actually use Roth annuities. So now you have money inside of an annuity that's Roth money, and you receive that money tax-free. So there's different, it depends on where that money is. So annuities, it depends where you're holding the money, and then which ones, which account is it best served inside of, right? Is it the Roth? Is it inside of an IRA? Is it outside of the retirement accounts? So annuities have their own unique way of being taxed as well.
Thank you so much. Can you talk a little bit about what step up in basis is for real estate?
Okay, so here they come. So if I buy a house for $100,000, okay, and step up in basis is usually helps. You're really kind of talking about like death, right? So if
Correct, yeah, like inheritance.
Right? So let's say my mom bought a house for $100,000, and now the house is worth $500,000 30 years later. My mom passes away and hands me over the house at her death, right? Through, your inheritance. What is the basis of the property? Well, the answer is on the day of death. If she gives you the property, then the date of death, what the value of the house is that's what your basis is now. Okay, so it moves up from 100 grand to 500. And so now you own this property at 500 grand. Now, if you sell it next week, okay, for 600 grand, you're only going to pay taxes on the $100,000, right? And remember, we have long-term and short-term capital gains, right? So that comes into play too. Like when you sell it after you get the house. If you sell it immediately, now you're talking short-term capital gains. If you sell it, all right. Now, if you sell it for $500,000 and the house is worth $500,000, there's no gain, but you're getting all that cash, that the equity your mom created for you. Well, you're receiving all those dollars without tax because of the step up in basis. That's why step up in basis is so important. Your basis is increased. And then there's all kind of nuance around that. That's step up in basis in the simplest context.
Okay, thank you so much. So this one is a little more specific, so I'm going to generalize it. Can you talk about the pros and cons of buying a high dividend stock in a brokerage versus an IRA account that's a traditional account?
The pros and cons. Well, so when I'm inside of an IRA in the years of my growth, like building up my accounts, I'm not paying taxes on any kind of transactions that goes on. I can buy and sell stocks all day long, thousands of times over and over again. There's no tax from that, right? So if I receive dividends and if I receive interest inside of IRA accounts, do I pay taxes on those dollars? No, not while that money is growing over time. Okay. The only way I pay tax on anything inside of those IRAs is when I remove the money in retirement. Right. And so you're going to deal with the tax at that moment in time. It doesn't matter if it was a contribution via dividend or contribution. It's just like how you remove the money. Once you remove the dollars, that's how much you're going to pay in income tax for the traditional IRA. All right. Now, in the brokerage account, that was kind of what I was alluding to before. When I have dividends inside of a brokerage account, right, and depending upon how I got the dividend, right, if it's just a typical normal dividend that we get from blue chip stocks, that's what we call qualified. If I own it for a specific period of time and stays inside that portfolio, now you're dealing with qualified dividends and you're probably pay 15 to 20% on taxes on those dividends, right? But if it's not qualified, and there's a whole list of reasons why dividends are not non-qualified, well, then you're going to pay taxes at your income level, so higher. So if you've got to be strategic about where you stick your stocks, right? What are they for? Like, are they, am I just doing this as part of a long-term, like retirement strategy, or am I using the dividends in a brokerage account in retirement as my mechanism for income? Right? Because you could just not leave your stock account alone in retirement, your brokerage account, right? Call it $1 million. It's just sitting there. But every year it's spitting off 3 or 4% per year in dividends. Well, that's your form of income, right? And depending on what kind of dividend it is, will be the kind of, but you have to think about that strategically, like with your professionals, like, do I want my high dividends in my IRAs, or do I want in my brokerage, or both, or spread it out evenly amongst the two, right? So you could, there's so much nuance to that. So.
All right, we have time for about one more question. How do you know what tax bracket you're going to be in if you're in your first year of retirement and you're no longer taking a paycheck from an employer?
Okay, so depends on the year. So if you're taking, so first thing you got to understand is, first place I started is Social Security, right? You're going to have a pretty good idea. Remember, like it's hard to do this on your own. So like, think of it like, here I am January 1st. I retired December 31st. Now it's January 1st of 2023, and I'm going to look at how much money am I going to pay in taxes. Well, you already know how much money you're going to receive in Social Security if you're taking Social Security. If you're taking Social Security, you kind of know what that number is going to be. So then, if you break that rule of, $44,000 if I'm a family and $34,000 if I'm single, well, now you already know 85% of those dollars are going right into my income tax bracket, right? So I just throw that in there, right? And then I go, okay, how much money do I need to eat, sleep, and breathe, right? So you have that like amount of money, and let's just say you go, the only thing you have is a 401k. Well, you pull that money out of the 401k, what you need to eat, sleep, and breathe, right? And now you have your Social Security plus your 401k, do the math, and there you go. That's how much money you've made that year in the form of income without any standard deductions and all that other stuff. And you can start doing the math and go, okay, well, it looks like I'm forcing myself into this, 28% or 25% tax bracket. Gets a little more complicated because if you have something called RMDs, required minimum distributions, and you don't want to take out so much money, but you have to take out extra money, well, you're just pushing yourself into a higher tax bracket because you have to take the money out. So that's one way to do it. Trying to think of other, yeah, you do the best you can to figure out. And as you start pulling money out of these, a lot of people just don't take. If I need 100 grand to live off of, not everybody just simply takes it right out of 100 grand out of their account, right? They usually sometimes will take, monthly, right? So it depends.
All right, I had another question came in that I think we have enough time to answer it.
Yep.
Why is it so bad to jump into the next tax bracket? So if you only have a few $100 to $1,000 that got you into the tax bracket, that's the money that is taxed at the higher tax bracket level. Is that correct?
Yeah, it's not the worst thing in the world, but I mean, you're like, it's the concept. Why are we obsessed in society of not paying so much money in taxes? Right? I mean, that's the question you're really asking me, right? You're like, oh, what's the big deal? It's only a few bucks, right? Well, why is our whole society focused on not paying those dollars? Why are we trying to avoid it as much as possible? There's got to be a reason, right? And that's really the question is, well, if you want to just give the government the money so they can do all the good that they do with our dollars, then be my guest. Don't even worry about all this stuff. Just put your money where you feel. But if you're like, you want to keep it as much as possible because you want to do something that you feel is better than what somebody else gets to do with your money, that's what tax planning is all about. It's like, who do you want in control of the dollars? Someone else or you? That's really, to me, what your question is. But I get your point, right? Like, it's only a few bucks, who cares? Right. But people say that. I get that a lot when people talk about like when they get a raise. They go, well, like, I got a raise, therefore I'm paying more money in taxes. I don't even want the raise. No. You want the raise. I promise you.
All right, folks. So that's about all the time we have for questions there. And I do want to thank JR for being here and for answering all these questions and explaining taxes in hopefully a method that was not painful at all. I think pretty good, entertaining as well. All right. Well, on behalf of Advice Chaser, we want to thank the organizations that have made today's webinar possible today. And to our attendees, look for a link to the replay of this event. We will be sending that out. You're welcome to share that replay with friends and family. Here at Advice Chaser, we're all about helping you find a financial advisor who's a great fit for your life and your financial questions. We're getting a lot of thank yous in, by the way, JR. Our matching service is free to you, and every one of our advisor partners has committed to offer a free initial consultation to anyone we introduce them to. Find out more by going to advicechaser.com and clicking on the link to find an advisor. Once again, from Advice Chaser, thank you so much for coming, and we'll see you at another webinar soon. Goodbye, everyone.